Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. I'm recording this update on the U.S. business cycle after market close on May 6th. That's Monday. That is after the president tweeted about increasing tariffs on China. Clearly, this chart book here is not intended as a minute-to-minute interpretation of economic data. This chart here goes back to the late 1920s. We show this one, as I've indicated many times on these calls, that this is intended to show that during economic expansions, risk assets perform reasonably well, whereas during recessions, historically speaking, they don't perform well. Leading economic indicators have come down. The yield curve steepness has kind of petered out here a little bit. The premium chart book shows different periods of that, slice and dice a little bit more, has several other treasure troves. Please look into that as well. The premium chart book is very much worthwhile. Also, you may want to follow me on Twitter, where I sometimes show additional charts. A context I'd like to give: last Friday, I was at the Hoover Institute Monetary Conference, where several people at the Fed were present. The takeaway I had from that was that a lot of people at the Fed say that inflation has been below the target for 10 years. That is correct, it's just a statement, but they conclude from that it is a problem and they got to do something about it. They believe that if we do have to, or if the Fed has to cut rates down back to zero, that they might have a difficult time getting inflation up. And that's why they talk about these things. That's why they talk about these things about having a dynamic targeting, and that maybe they can have inflation above 2% to be more credible as they go down. The San Francisco Fed president might be the most extreme in that. She says we pretty much have to let inflation go above 2% so that we are credible when we are back at zero, that we will do something to get inflation back up. And the problem I have with all of that is that, yes, of course, inflation has been less than 2%, but the question is, are these structural reasons, or could it be that they're just the quote-unquote normal reasons, most notably that we're pulling too many people from the sidelines into the job market? And we can do this right now, but at some point we may hit a limit where it's going to be not just resulting in wage growth, but with general inflation coming out. And if you only then tackle inflation, in my view, that's a bad policy mistake. And so all this on the steepness of the yield curve, the context here is, aside from the fact that I just wanted to mention the Hoover Institute, is that may well be a reason why they're more sensitive to the yield curve inverting than historically, because historically, of course, you want the yield curve to invert if you think that inflation is moving higher and you need to put the brakes on economic growth. PMI has come down, but above 50. The global picture looks a little mediocre still. Germany has ticked up, but not as much as expectations were. China is above 50. And if I may, I'll just, I saw a headline here flashing across, and the headline that I'm seeing here across is that Mnuchin and Lighthizer supporting the Trump move, that there was a change in the tariff talks. Who knows? That may just be politics. So back to this chart book here on my real-time interpretation as news is coming out. Job gains and the job reports were very strong. And so, again, this is not sustainable. Every economist will agree on that. The question is only when we're going to hit the not sustainable, because the population growth isn't enough. Immigration plus population growth isn't enough. So that means at some point we're going to run out of workers to join the workforce if this continues. And of course, we'll stop before that at some point as it gets more difficult to pull people into the workforce. And if and when that happens, we might have an issue with inflation, and that's independent of globalization issues, that there's overall downward pressure on inflation and whatnot. So to me, what is concerning is that we don't hear those voices of concern at the Fed. Unemployment rate, quite low. There were some things in the unemployment report that suggest that maybe the unemployment report is not quite as strong as some people think, but generally speaking, a strong unemployment report. The reason why it was a little bit weaker was, amongst others, because not all industries benefited from it. Also, the birth-death model had added quite a bit. And let me just here show you this Atlanta Fed indicator appears to be reasonably good, continues to be reasonably good. Obviously, the first print in the GDP number and their inventory buildup contributed to that. But it was high, and so that one was good. Obviously, a lot depends on whether these Trump comments are going to result in real damage, just as China had shown some improvement. Credit cycle, according to this metric, which is focusing on the on items like mortgages and like that is not as sensitive. If you look to the more sensitive areas in the consumer, yes, there has been an uptick in the delinquencies. If you kind of zoom in on that, lending standards here, they are easy, and even late last year they weren't so bad. And so it depends on high yield spreads. Yes, they spiked here a little bit and whatnot, but the question is, did the Fed overreact? And right now, lending standards are extremely easy. So this lower end of the neutral range, I think, is very much still in place. And I wonder whether that is justified. Housing market slowing a little bit. Now, again, these data are a little sluggish because we don't update them so frequently, or they're just not available as frequently. Mortgage rates had come down, so that might boost growth here a little bit. Here you got the summary. You can download the PDF, watch the premium report, and oh yeah, don't forget the disclosure and give us some feedback. Thanks for listening. Thanks for watching. Have a good one. Bye-bye.